Kulp here with Eagle City Multifamily. The views and opinions expressed are provided for informational purposes only and should not be construed as an offer to buy or sell a security or to make or consider an investment. While the information contained in this presentation has been compiled from sources we believe to be reliable, neither the sponsors or their representatives warranties the accuracy, completeness contained herein. All financial information and projections are provided for reference only and are based on assumptions related to the general economy, market conditions, and other factors beyond our control. Prospective investors are encouraged to conduct their own independent due diligence investigation, review financial projections, and consult with your legal, tax, or other professional advisors before making an investment decision. What I'll cover about us: why commercial multifamily, and strategies, value add, and choosing the right market property, and what's in apartment syndication, deal structure and fees, tax advantages, how to invest. We started Eagle City Multifamily to empower our friends and family with the knowledge to build wealth and real estate and bring opportunities to build passive income. I should tell you how we came up with our name, Eagle City Multifamily. I lived in Emory, Texas for years, and Emory is the Eagle capital of Texas. That's why the name Eagle City Multifamily. We come to the question, why commercial multifamily, otherwise known as apartments? 100% passive income. You don't deal with tenants and toilets and trash. We take care of that part. Forced appreciation. We deploy capital to improve parts of the apartment that will generate the highest increase in rent. This increases the net operating income and increases the value of the property at sale. Inflation hedge. As inflation rises, so do property values and the rent prices. Over time, this will result in higher rental income. Tax benefits. Our government rewards activities that provide housing. Bonus depreciation. 100% deduction on assets with less than 20 years of useful life. The depreciation can be used against other passive income and capital gains, or active income if you're a real estate professional. Cost segregation properly categorizes assets into the correct classification and recovery period for the federal and state tax purposes, and front loads depreciation for real estate assets. Cash flow. Receive regular distributions from property's cash flow. Real estate versus stock. Real estate pros. Tax benefits, leverage, property appreciation, physical asset, cash flow, plus upside hedge against inflation, tenants, pay down mortgage. And the cons: your money is not liquid, meaning your money is in the property until the property is sold or refinanced. Typically a higher barrier to entry. Right market and location. High population growth. Texas's third highest population growth, 16% from 2010 to 2020 according to U.S. Census. High job growth. Texas sizzling 6% job growth over the last year. Low new inventory. Decreasing vacancy over the last 2 years. Landlord-friendly environment. No caps on rent. Diversified industries. Here are the top 10 markets by Marcus and Millichap. These are not in any certain order. Here are they: Fort Worth, Texas; Austin, Texas; Houston, Texas; San Antonio, Texas; Atlanta, Georgia; Charlotte, North Carolina; Raleigh, North Carolina, Las Vegas, Nevada, Salt Lake City, Utah, Phoenix, Arizona. 4 of the top 10 markets are in Texas. They also list 26 middle markets that I will not take the time to list today. What's an apartment syndication? Pool money from numerous investors that will be used to buy an apartment building and execute the business plan. This process is regulated by Securities Exchange Commission, SEC. Together we can make big deals happen. Here are some steps involved in an apartment syndication. Apartment deal. Number 1. Typically there is debt, agency or bridge loan, equity from partners, individuals as passive investors, managers as general partners, and then the sponsors or active investors or operators. Right property. These are 4 types and age groups of apartments. A-class, newer properties built within last 15 years, no to very little deferred maintenance. B-class, built in last 15 to 30 years, some deferred maintenance. C-class, built 30 plus years, outdated 1970 to 1980s product, usually more deferred maintenance. D-class, older buildings in challenging neighborhoods with high deferred maintenance. These are the 4 typical classes of apartments available. We look for the sweet spot, best value for your buck. B and C class. Nearby comps are over 90% occupied, have higher rents, over 85% occupied, stabilized, good bones with minimal deferred maintenance, strong current cash flow, potential to reduce expenses, increase revenue, and or improve existing property management. Deal structure. This example, 80-20 straight split, limited partners, 100% passive, and are not involved with day-to-day operations. General partners, locate and structure the deal, raise equity and find debt, perform due diligence and close on the property. They execute the business plan and choose when to sell to maximize investors' return. Who can invest? It depends what SEC rule we use. SEC stands for the Securities Exchange Commission. SEC Rule 506D accepts accredited investors only. I'll explain an accredited investor later. Rule 506B provides an exemption under Rule D of the Securities Act. This exemption provides a way for companies to raise money and sell investment opportunities to both accredited investors and a limited number of non-accredited investors that are sophisticated investors. I'll explain what a sophisticated investor is in a moment. Under this rule, the company offering the investment cannot advertise or publish investment details publicly. If you are not an accredited investor, you need to be a sophisticated investor to invest in a 506B deal. Here is an explanation of a sophisticated investor. You have the knowledge and experience in financing and business matters, and therefore capable of evaluating the merits and risk of the prospective investment. Here is an explanation of an accredited investor. Annual income of $200,000 if you're single, or $300,000 if you're married over the last 2 years, or $1 million net worth not including primary residence. This can include other income and accounts, other properties, 401k securities. Here are some sources of capital to invest with: self-directed IRA, home or investment equity. You can do a cash out refinance and take advantage of low interest rates, stocks, savings, CDs, checking, previous employers' 401k accounts, and most retirement accounts. This is all for now. Please consider subscribing and pressing the like button. See you on the next video.